Last week, we had some pretty big moves. This week was a little bit more subdued, but we had some comments from the new U.S. Treasury Secretary. And here to break it all down is Jim Welsh with Macro Tides. Jim, how are you? Good to see you.
Good to see you, Blake. I'm doing good. Hopefully you are too.
I am. It's at the end of the week, and I'll tell you, there's been some comments from the Treasury Secretary Bessent, and last week you were really starting to scratch the surface on what the Trump administration is trying to do here, and you said they're really threading a needle, but you wanted to really focus on it a little bit more today,
Yeah.
and why
Yep.
is that?
Well, I think it's important to try to get a handle on what they're trying to accomplish so that some of the things that they've already done, plan to do, and will probably do more of, have some context. Because, I think what's happening near term, Blake, is the attention has been, oh, they fired these people. They closed this department. Oh my God, they're getting rid of all the DEI stuff. Oh my God. And to me, that is small potatoes relative to the bigger picture of what I think they're trying to accomplish.
Which is world domination, right?
No, what I would put it as Trump has been saying for a long time, make America great again. And the policies that they're framing and implementing, the goal is to make the U.S. stronger. And if you look at some of the weaknesses that we currently have, things like uh, debt exploding in the last handful of years, interest expense zooming above $1 trillion. Those are on unsustainable trajectories. In the meantime, from a global standpoint, uh, there's threats from Russia, threat from China, and how are we going to address those? And what Trump is also saying, and has been saying really since 2017, is you need to step up and spend more on defense. And in effect, he's saying, you guys build up your defense so you can more effectively deal with Russia. And we're then going to focus on China. And coming up with this concept that for decades, the U.S. has provided a umbrella of defense and security that we've incurred a great amount of cost. And so what he's trying to say is, all right, those days are done. And he also said this in 2017, that it was time for them to step up spending. But so the idea being is they're really trying to transform how the world has been operating for the last 40 or 50 years and kind of do a major reset. And I think once one gets an understanding of that, it starts to make how these different pieces make sense and then how they integrate into an overall game plan. So what I'm trying to do for myself is understand this stuff because it's important because it will have impact on financial markets. And so over the coming weeks, we'll probably touch on different aspects of it. But today I wanted to present more of the broader picture. And it's based on a comment that Besson made in a speech in June of last year. So this is long before he was even under consideration to be Secretary of the Treasury. There were two or three other people that were, kind of like, well, they're talking about the guy who's now Commerce. I can't remember his name. Um,
Lutnick. Is it Lutnick?
Nutmeg.
Yeah.
He was like one of the inside leaders, if you will, for the Treasury job. So my point is, here's a guy who expressed something in June of 2024, and I think that caught Trump's attention, and that's ultimately that philosophy that he discussed is part of the framework that they're operating on.
All
So
right. Well,
what his
this is the
statement,
comment that you were referring to.
yeah, yeah, we are going to have some kind of grand global economic reordering. I'd like to be part of it. I've studied this. So he brings a certain amount of expertise. You should look up, if you haven't, his background and so forth. So, people have been assuming that this tariff stuff and Trump's threats are just negotiation. That's all it is. And it's going to be like 2018, a lot of bluster, and then it's going to be like, okay, we'll settle for some small potatoes, and then we'll kind of, proceed. I don't think that's the game plan here. I think that the tariffs in multiple different manners are going to serve the purpose of having a grand global economic reordering. And so I think that's one of the surprises that potentially can come for markets because the assumption is we're not going to have a lot of inflation. It'll be like 2018 and we don't have to worry about it. If I'm right, and this is the path that they're really headed on, then markets are going to have to deal with a much more aggressive approach by the Trump administration on tariffs and using tariffs in a number of manners. But one of the things that happened from 2001, after China became a member of WTO,
Hmm.
manufacturing jobs dropped from 19 million to about 12 million in 2009 and 10. And some of that weakness was obviously the great financial crisis. They've rebounded up to about 14 million. But losing 20% of your manufacturing base is not good. And so it the Trump administration believes that you cannot be a global world power if your manufacturing base is eroding. You need your manufacturing base to be able to produce military stuff, also produce the kind of computer chips that go into defense and just about every part of this society, and pharmaceuticals. And then, if you look at what happened with COVID, the supply chain breakdown. Well, if you have a lot of your production offshore, you are very vulnerable on many levels to that. And so this is a reordering of how can we get manufacturing back into the US? And one of the ways I think Trump is going to use tariffs is okay, 25%. All right. If you want to avoid that tariff, move your production to the US instead of making it where you're at, selling it to us and paying a stiff tariff. Just bring your production here. Well, that'll boost manufacturing jobs. But the problem is for countries like Germany, who are really struggling economically, their economy hasn't grown in 2 years. In France, which is not doing great, the idea of companies moving a chemical plant out of Germany over to the US, I don't think they're going to like that idea very much. So my point is, I think these are the grand designs of where the tariffs fit in, and I'm not sure a lot of people fully appreciate it. And so, this is trying to use all the different pieces to make the U.S. stronger, less dependent, and less vulnerable over the next 20 years. This is a big, a grand economic reordering. I'm not sure. I'm still working to try to figure this all out. There's other things we'll talk about in the next few weeks, but just I wanted to give an overview
All right.
that I don't think people are fully tuned in to the magnitude of what they're trying to accomplish.
Well, we did get some Eurozone PMIs, and their manufacturing PMIs weren't too bad. Their services PMIs really tapered off. But here in the U.S. As well, I mean, we had data come out, and our services PMI came in worse than expected as well. But our
Yes.
manufacturing PMIs came in a little bit better than expected. But I think that services PMI really is kind of got some people's attention since we are so heavily skewed to the services sector. But as you're pointing out, the Trump administration would really like to change course of that, or at least yeah, make us less dependent on services and more of a manufacturing base.
Well, I think they want to keep both sectors strong. I mean, part of what they're doing in terms of cutting government regulation, the burden that that poses and the cost that it poses, by reducing regulation, hopefully more companies will invest more money, and with those investments, generate more growth. So that's another part of the game plan. But tariffs are a big function in terms of generating revenue. So we have this gigantic here. Let's go to the first chart because I think we'll breeze through these very quickly. So this is a 50-year average from 1973 or beginning of 73 4 to 2023. And the point being is the 50-year average of spending is about 21% and government revenue 17.3. So obviously we have a structural deficit on average for the last 50 years of over 3%. And in last year, spending was 24% of GDP and revenue was 17.2. So in other words, we had a deficit of almost $2 trillion. It wasn't because revenue collections were way down. It was barely off the 50-year average, but spending is 15% above the 50-year average. So how do you get spending down without overly weakening the economy? As you and I have talked for quite a bit about this, you go from 2 trillion to 1 trillion and you eliminate $1 trillion worth of government spending. What do you think is going to happen to the economy? It's definitely going to slow. So what they're trying to accomplish is let's cut spending, do it in a way that doesn't overly impact the economy, but at the same time, do other things to help spur growth. So the Government Accountability Office, this is a government agency. It's independent, nonpartisan. All right. So all this hue and cry about, oh my God, President Musk is doing all, oh, they can't do that, And it's like, wait a second, folks. Here's an entity within the government last year, before the election, said, you know what? There's somewhere between 230 billion and 520 billion dollars annually of fraud. That's a lot of money. So why wouldn't you want to go after something like that? That should be the responsibility of the government as a caretaker of money they take from its citizens and companies to make sure it's being spent as wisely as and getting the biggest bang for its buck as possible. So, what they're attempting to do is, all right, let's identify that fraud and eliminate it. And we're going to save right off the bat a chunk of money. Somewhere in between that, the 200 and 500 billion would be my guess is what's achievable. Reducing federal employees. The average federal employee makes 108,000. People forget back in the 90s when Bill Clinton was president, uh, they had a program, Reinventing Government. They got rid of 375,000 federal workers. I think the Democratic Party has lost its mind. They don't remember that was done in the 90s. But now they're going to be, oh my God, oh my God. It's like, wait a second. Bill Clinton did it, and it was good because the only 2 years we've had a deficit surplus, or permanent deficit surplus, a government budget surplus was in the late 90s. Some of it was because of what they did. In addition, the dot-com bubble generated an enormous amount of capital gains tax revenue. But my point is, these are common sense approaches in cutting ineffective programs. Once a program starts with the federal government, every year it just gets more money
Yeah.
automatically. As opposed to, well, wait a second, some programs are really good and beneficial, but then we have other programs that we're spending a chunk of money and we're not getting the results we should. So to me, this is long overdue, Blake, but this is one way that they can cut spending, I think, in a positive way, obviously, without uh, hurting a lot of people in the process. So for me, I just want to, I'm not going to prejudge any of this stuff. Let's see how it shakes out. One of the best things has said is one of the key parts of the economic plan is to extend the 2017 tax cuts. It over a 10-year period is about $4 to $4.5 trillion. So they look at that as being a foundational aspect of how can we keep the economy on a firm footing. And I'll point out the chart before when I was talking about 17.2% of government revenue last year. Well, that's under the after the tax cuts are still operating. So my point is extending it isn't going to cause revenue to go from 17.2 to 16.5 or something like that. That's where it is right now. And uh, what they're trying to accomplish here is using tariffs to offset the cost. It's still, you're foregoing $4 trillion worth of revenue over a decade. Can you raise 400 billion bucks a year to replace that? And that's, again, when you start penciling out the tariffs that they've set, 25% on Canada and Mexico, 10% on Europe, and the tariffs on China, it's over 300 billion. These guys are serious about how can we do this? And the problem is that, it's going to be inflationary. There's no way, in my view, it's not going to be inflationary. And that's a problem. And they're hoping that by cutting government regulation, they want to get energy down by 50%. That isn't going to happen. So there's some real challenges. And, I have doubts that, okay, I get what you're trying to do. I'm not sure we're in an economic environment that you're going to be able to succeed. Oil companies are not going to spend like crazy. And if oil prices drop below $45, $40 a barrel, guess what? There's a lot of wells that aren't profitable anymore.
Yeah.
So there's some real constraints in terms of what will be achievable. And the clock is ticking. The midterm elections, November 26th. There's a lot of people that voted for the first time in their life for a Republican, and it was because the cost of living has gone up so much. Well, guess what? I think it's going to be nearly impossible over the next 18 months to get the cost of living down. So to me, this is a huge, I think it's needed and necessary. I just think it's going to be really difficult to accomplish. And I'm not sure they've done a very good job of communicating the importance of it. So this is the defense spending. NATO's countries pledged to spend 2% of their GDP on defense. Well, as you can see, for a long time, their defense spending went down from 2006 to 2014. 2016, the vast majority, 5 out of 31 countries, were meeting that 2% goal. The other 26 weren't. And so Trump said, hey, folks, we're doing all this stuff and spending a lot of money, and you're not living up to your end of the bargain. And in response, the country started to respond. Spending on military and defense went up about 25% from 2017 when Trump made those remarks to 2022. And then obviously got a real big kick in terms of after Russia went into Ukraine. That beige line is what it should be to be 2% of GDP. And you can see the huge gap. Now it's closing. And I think by the end of this year, that gap will be closed. But Trump is also saying, I think you should increase it to 5%, which is, I think, ludicrous. But if you say 5, maybe you'll get them to go to 3. But the idea here is that they need to spend more money, build up their defenses against Russia. So that's, again, all this stuff about Trump, oh, he's in bed with Putin. Well, wait a second. In 2018, Trump said to Germany and the other EU countries, you're depending on Russia for your natural gas. You guys are stupid. You're crazy. Why would you depend on Putin as opposed to us for natural gas? They laughed at Trump in 2018. And then we know what happened in 2022 when the gas got shut off. And so my point is, if you look at what Trump has said directly to the EU, you need to boost your defense spending to deal with the risk that Russia poses. Gee, that doesn't sound like some guy who's cozying up to Putin. That sounds like some guy who praises Putin because his ego likes it. Putin's, that is. But at the same time, talking realistic to Europe and what they need to do. And of course, they didn't like, J.D. Vance gave a speech last week, Blake, and, he kind of said, you guys are off course, effectively. And they didn't like it, of course. But this is the new reality. And, I just think it's like, okay, these guys are looking to reorder the way we've been operating for the last 30 to 50 years. It's big time stuff.
All right. Well, so some real big picture stuff. And matter of fact, before we get into the other stuff, the charts that Jim talks about, if you enjoy Jim putting all this together for you, make sure you give him a thumbs up and subscribe to the channel. Get down there in the comments below if you have any comments regarding what Jim's talking about the global domination of the U.S. and reordering everything. Or if you want to get some of Jim's content, make sure you send him an email at
Yeah,
jimwelshmacro@gmail.com, correct?
that is correct. Thank you,
All
Blake.
right. All right. Well, let's do this. Let's get into the charts that matter. The charts
Yeah,
that will be moving the markets that you think, and let's start with the dollar. So the dollar,
yeah,
um, Jim, I'm going to point this out just because I don't see it on your chart, and so I'm just going to draw it out for everybody. From right here, this low in September to this high in January, this is the 38% retracement. We actually hit it to almost to the pip yesterday
yeah,
afternoon and
yeah,
bounced. But is the dollar over? I mean, do we start heading up from here? I mean, if we're going to implement all these tariffs, is that is I mean, and the Trump administration's real regarding that. We should see the dollar strengthen from here. But what are your thoughts technically? What do you see?
yeah. Well, again, the thought has been is that we're going to see the dollar trend lower after it got to the, above 110. So far, that's kind of been happening.
It has been, yeah.
Um, it's starting to get to where it's oversold. So a dip under 106, to me, the RSI will be down towards 30. So we're likely to get a bounce. That very well may coincide with on March 5th, I believe is the day where we'll be past the 30-day deadline. Remember February 3rd, the tariffs on Mexico and Canada and so forth,
Yep.
30 days extension. Well, I think that's March 5th. So again, I think this is going to be a more serious issue, and that very well could provide the dollar a decent sized bounce coming off support, being oversold, more news, just like that spike up to wave two there. That was February 3rd when the announcement came. So to me, we're setting up for another probably a bounce here. That again, we have to see how things respond. My take is Trump favors a cheaper dollar. And we'll talk about this in more detail. But the dollar being the reserve currency almost has some built-in demand factors that even though we have huge trade deficits, normally that would cause a currency to go down. But because of our status as a reserve currency, provides underlying support. So the dollar is pretty expensive. Well, if you're an American producer and you're trying to sell to the rest of the world, the cost of your goods is more. So part of their grand design is how can we get the dollar down uh, and not lose reserve currency status. So that's another one of the goals of the grand design and reordering. But near term, technically, I think the trend is down. We're going to get a bounce sometime over the next 2 weeks when that announcement regarding the tariffs hits. But I think after any bounce, the dollar's headed down more.
All right. So the next chart you brought is TLT. So this is basically, in a nutshell, the 20-year notes bond market.
Yeah,
So
I
what
think
what
the
do you?
average maturity on TLT is about 27 years, like
Okay, so it's
26,
more of a
27.
bond market.
Yeah, it's longer term.
Yeah.
Yes. So, just very simplistically is like, okay, the dollars or the TLT's been making lower highs. Treasury yields have been making higher highs over the last handful of months. And there was a trend line that was broken. We bounced up to it a couple weeks ago. We're still under it. So just very simplistically, it's like TLT's in a downtrend that has not been negated. I still believe that a retest of the low, below 85 is likely. And today, TLT got a bounce because, as you noted, the ISM service number came in under 50. Services are about 80% of GDP, manufacturing is 12%. So the relative importance, as you noted, those are the numbers behind that. So again, my take is I'm standing aside, waiting for that retest. And, the other real test will come on potentially March 5th, or maybe the days leading up to it, is their leaks about what's happening with the negotiations. I think for me, it's very difficult to see that tariffs aren't going to have some kind of impact on causing inflation to rise.
Okay, and
So
so in
how's the
that
bond
in that
market going to handle it?
instance, what we should see is we would see TLT would come back down and yields would rally.
Yes,
Okay.
yes.
All right.
And then my expectation here is like the last three lows, TLT made a low, was oversold, bounced, and then made a lower price low,
Mm.
RSI divergence. And then you can see back in October of 23, April of last year, November of last year, each time you had that setup, price action subsequently followed with pretty good rallies. So I'm just standing aside until, since I do think tariffs are going to be inflationary, we'll see how the market handles that.
All right. Well, the next chart you brought is gold, and gold has been on a nonstop, juggernaut move higher.
Yep.
So,
Yeah. No, we've talked the last 2 weeks. I had some charts 2 weeks ago showing, what appears to be all the earmarks of a short squeeze taking place. And it has continued pretty much nonstop. For the first time, technically, you can say, okay, the recent high in the last few days, RSI didn't confirm it. And so to me, this looks like we've had wave one up, two, this huge protracted move is a wave three, very persistent, very strong. I think we're nearing the end of wave three. We'll have a pullback for a four, and then there'll be another rally that takes gold above the 29.54 high. And then we'll see where we're at. Potentially, that could be a fairly significant high. Yeah,
okay.
one that would last for months, not
Okay.
just
So if this is wave three, we may be done near term, but it shouldn't be the end of the trend yet.
it's wave three of five. You can see where I have wave three. So that high at 27.89 was the end of wave three from the low back in September of 22.
Okay.
So,
And this
we're
would be
coming to
four, and then we're gonna make five up
we're
here.
in five here, right?
Yeah, okay, got it.
And that's my view has been. I thought we'd have a pullback below 25.41 and then have this big move. Instead, we had this big move in the dynamics of the short squeeze. Well, I didn't see it coming. So
No, and you'd be foolish to believe that you're always going to, Jim. I mean, that's for
no,
us as
no,
traders, but I like the wave count thus far. Let's see if we get
yeah,
five waves unfolding here. Now, what it ultimately means, though, for the S&P is the S&P is not far off of its highs. I know we're having a bad day today, but I mean, in the grand scheme of things, Jim, where are we going?
yeah. Well, from the grand scheme of things, taking a bigger picture, one of the better indicators technical analysis provides is the advanced decline line relative to the S&P. I mean, I can go back really to the late 1920s. In
Hmm.
every bear market, large, intermediate declines of 10% or more have historically been preceded where the S&P is making higher highs, but the advanced decline line isn't confirming it. And so many months as we were going up until we got to November, the 80 line kept making new highs, the S&P made new highs, everything's copacetic. What we can see is since November 29th, the 80 line has not made a new high, even though the S&P has. And so to me, this is a big time warning. Now, the one thing, markets don't go down just because they're overvalued or the AD line is doing a divergence or any of that happy stuff. There has to be a reason to sell that convinces people that, it's time to take some money off the table. If I'm right about the tariff path that I think the Trump administration is on, it's just counter what Wall Street is assuming that it's not going to be that big of a deal. That obviously could provide a pretty decent reason to sell. So I just think that this is a window of time to be pretty cautious because when the decline comes, I think it'll be pretty hard and fast. And that March 5th tariff deadline not too far away.
Coming up
The
less than 2 weeks. So
Yeah, you
yeah.
know. So also there's a trend line of the last two lows that the S&P came down to and just about touched this morning. So I don't know where we're trading right now. The S&P was down 40 some points when it did that. So
Yeah, we're just not too far off of probably those levels. I mean, we're
yeah,
stabilizing down here. So,
yeah.
but
So
Jim,
again, that looks like a wedge type of a chart line.
yeah,
And you take that out, you get a quick drop, which then opens the door for a decline below 59.24. One thing I'd point out, last week I said, hey, I think we're going to go to a new high, maybe wave three, that you had an ABC down, all that happy stuff. Well, the price action on Tuesday and Wednesday and yesterday, even before today's weakness, was not the kind of thing you see for a wave three. Wave three is always the strongest, most dynamic part of any advance or decline. Well, obviously, okay, we made a new high, but was it convincing? Was there a lot of thrust behind it? No. So
Yeah.
to me, that opens the door to a drop below 59.24, and the 80 line negative divergence says you can't just, dismiss
Can't
that.
ignore that. Yeah, you can't ignore it.
Yeah. Yeah. These are
Well,
tough
Jim,
markets. I mean, we're all waiting for news,
yeah.
and we're not talking about inconsequential news. This is big time stuff, and I
Yeah.
think the next weeks are going to be pretty amazing.
Well, guys and gals, if you've enjoyed, our time together with Jim, make sure you give him a thumbs up. Thanks for painting us the bigger picture. As deciphering the Trump administration and what they're trying to do is really it's been challenging, I think, for a lot of the market, and that's why we're getting a lot of choppiness around current levels and I appreciate that you do that. So if you guys at home do, make sure you give Jim a big thumbs up. And Jim, I'll look forward to catching up with you next week.
Yeah, one last comment. It's hard sometimes to get past Trump's bombast. You know,
Hmm.
it's easy not to like him or like, wow, this guy doesn't behave presidential material type. That's never going to happen with him. All right. When he makes statements like, well, Ukraine's responsible for the war. It's like, come on, that's borderline asinine. And so that's the kind of stuff that I think people viscerally respond to. And what I'm trying to do is, okay, let's put that aside and let's focus on what they're trying to do and why, and see through some of that bombast and bluster and all the rest of it, because that's the nitty gritty that's going to make a difference.
Very good. All right, Jim. Thank you so much for spending your time with us. I know I appreciate you, and I know the traders that are listening to you every single week wait for this interview, with their Saturday morning coffee. So, have a great day, and I'll look forward to catching up with you next week, Jim.
All right, thank you, Blake, and thank you for tuning in, folks.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.